Welcome, my name is Mark Umber, and in this video we're going to set up an LBO model. This is part 2 of a series of 2 videos. If you haven't watched the first one where we set up the basic model, you might want to reconsider doing that first. Now in this video we're going to augment our basic model to create an LBO decision-making tool. We have a proposed LBO transaction and we want to see how attractive this company is as a target and how certain value drivers and efficiency gains impact on the profitability. Here are the basic assumptions to model our LBO. We assume an EBITDA multiple of 8, a target senior debt to equity ratio of 3.5. We will assume that there will be transaction costs in the amount of 4% of the total funding, plus an extra 1.2% of additional reserve. The target total pure equity that is provided by general partners and the management should not exceed 25%, and we have a target management ownership of 10%. Now the funding structure comes with a certain cost of debt. The interest on the senior debt is 5%, and we're going to introduce a shareholder loan as a pay-in-kind loan that comes at 10% interest. All other debt will be set to 0% of interest. This is the basic model that we set up in the first video, and we're going to assume that the LBO will take place in early 2022. So we're going to use the 2021 figures to basically have the last snapshot of financial figures of the company, and as of 2022 we will augment this model to make it an LBO decision-making tool. Now, to set up some of these assumptions and to have all inputs and outputs on one sheet, we add this LBO sheet, and let's start with the assumptions. By looking at the markets, you see that the EBITDA multiple currently is an 8x multiple on the EBITDA. Now, we know the EBITDA from the basic financial model, so we simply go into the profit and loss statement, and since the transaction will take place in early 2021, the last known EBITDA will be 313. This gives us an enterprise estimate of 2.5 billion euros. Now to get to the equity purchase price, we first need to get the net debt of this company. So we go to the balance sheet, take the sum of the short-term and the long-term debt minus cash. This is equal to 6, and we can calculate the enterprise value minus the net debt equals the equity purchase price. Now, we have a couple of further assumptions. We know that the equity purchase price is 2.496 billion. And now we need to know how much debt we need to refinance. This is all the debt that is existing in the company, excluding cash. We want to pay down all the existing debt, so we go back to the balance sheet, take the short-term debt and the long-term debt that is outstanding at the end of 2021, since the LBO transaction takes place in early 2022. We have an assumed transaction costs of 4%. And we have an additional capital reserve that we want to make sure of 1.2%. So in total, our total acquisition costs amount to 3.019. Since the LBO transaction will pay the market price for the equity and the debt, there typically is a big difference between the market price and the book value. We need to introduce a goodwill And for this, we need the total transaction costs, the total acquisition costs, and we need to subtract the net asset, also called the capital employed. The capital employed in its simplified version is the total assets, which is the sum of all book values, minus the current liabilities. Now, since we refinance all liabilities, the current liabilities that are left in the company are just the accounts payable. So we take the total assets minus the accounts payable. We will not take the short-term financial liabilities into account since we refinance them entirely. This is the net assets, which results in a goodwill of 248. The goodwill will be the first additional element that we introduce in our balance sheet. It is a fixed asset, and we will add this as the first line item. Let's make sure that we highlight this in a certain way. All the new elements and the changes will be highlighted now. And we introduced the goodwill in 2022. This is the time where the LBO takes place. Let's make this. Let's fix this. This will remain on the balance sheet. This is the first change that we introduce into the balance. So we need to make sure that now we have all elements captured in the balance sheet. Make sure that we use the formulas and always autofill towards the right. Let's go back. Now, before we dive into the sources that we need to fund the total transaction, we need to know how much cash we can strip off the company. Once we acquired all the equity, we have the say, and we can redistribute parts of the cash to finance part of this transaction. So if you run an in-depth analysis on this company, let's say your analysis results that the company needs 50 million to operate its business. So let's go over to the cash flow statement and add this line of operational cash requirement and say this company needs 50 million to run the operations. Let's make this so we see that addition. This means that we can strip off the company of 366 minus 50 million in cash, which is equal to 316. And let's immediately introduce this into our cash flow model. If we use 316 million to redistribute, this will also be a drain on the cash flow, and we will already introduce this at this stage to augment our basic financial model to become an LBO model. Okay, let's go back to the LBO model sheet. We know that we need a total financing volume of 2.7. We have cash on hand of 316. Now we can calculate the sources of the cash we need. We have a target leverage ratio of debt to EBITDA of 3.5, which means we take 3.5 times the EBITDA. This will result in a total of 1.1 1.095 billion in long-term debt. Let's assume we introduce no short-term debt. This is just to simplify the model. Now, in terms of the common equity, we know that there is a maximum of 25% that common equity should not exceed in terms of a fraction of total financing volume. This is 676. This will be split by the general partner and the management. Now, we do have a target holding for the management of 10%, which also tells us that the general partners will hold 90% of all the ownership. That means that the common equity that comes from the management has to be equal to 68, and the common equity coming from the general partner has to be 608. Okay, now we have a final gap to close. We have a total financing volume of 2.7. We have 1 billion in debt, 676 in common equity, and the rest will come in the form of the total of the shareholder loan, which is 932 million. So the total equity is the 600 and the 900, the amount of 1.6 billion euros. Okay, and now we can calculate the NB ratio. Since the general partner pays the regular market price and the management gets a discount on their share price, the management pays 68 for 10%, which gives us an implied valuation of 765, while the general partners have to put 608 plus a shareholder loan of 932 into this company to hold 90%, paying an implied valuation of 1.7 billion. And this gives us the NV ratio for the management of 2.53. Before we can introduce the new debt and the new equity into the financial statements of the company, we need to put down the interests and the cost of debt and cost of equity that comes with it. For the shareholder loan, we have a payment in kind of 10%, and for the senior debt, we have 5%. All other debt is assumed to have a zero interest payment. So let's go over to the financial statements, and we will start looking at the debt schedule, where we will introduce the financing instruments we just looked at. So I'm going to unhide a couple of lines here, and we're going to add the shareholder loan, and we're going to change the senior debt. Let's start with the senior debt. The transaction takes place in early 2020. So now we make manual changes. We will refinance all the debt by the new debt. We introduce new debt to the balance sheet in the amount of 1 billion. And we will change the repayment structure. Let's say we will start with repayment of 200, which we assume to sustain. We will see not until the end whether this is a sustainable level of payment to pay down the debt. We will see that once we're done. We also need to introduce the interests. The new shareholder loan also comes at an interest rate of 5%. It's the same nominal amount. Still, I want to highlight this just to make sure, to indicate that this 5% is coming from a different security. And now we can calculate these interest payments accordingly, and our model already translates this. Let's make this section blue. Okay, and we are going to introduce the shareholder loan also in the year 2022, the shareholder loan in the amount of 932. And this will come at a 10% interest payment in kind. Let's take the percentage rate of the pay in kind is 10%. Make this fixed number. And we can calculate how much this is going to be. Let's make that blue. Now this payment in kind shareholder loan will increase by this payment in kind. Let's leave that decrease blank so far, and we can calculate the end of period value, which is beginning of period plus the increase minus any pay downs. And the end of the period value is also the beginning of the next period's value. And now we can simply use the formulas and autofill to the right. We have zero interest on any other pay on any other. Okay. We do not introduce any other debt or debt-like instruments, and the interest rate on that would be 0 by the assumption. So our debt schedule is now augmented for all LBO elements, but we need to make corrections to the total interest now. We refinance all the debt, so we need to go up to the short-term liabilities. The company had 83 million in short-term liabilities. We will have an end of period of 0. By design, we refinance all existing debt. We will also refinance this at the beginning of the year. So we will have no final interest payments, no additional interest payments in the year 2022 on that debt. And now we need to make sure that the interest payments are correct. This is the total interest payments in cash. Let's take the total cash interest, because we now also have a total non-cash interest, which is our payment in kind. Just want to make sure that this is clear, so we also highlight this in blue. Talking about the cash interest, we need to make sure that this is the right interest payments that flow into our profit and loss statement. So I'm going to scroll up and check the interest payments. We will come back to this line item later on. This is correct. Now that we have the debt schedule, we can introduce the new securities into our balance sheet. Let's scroll up to the balance sheet. Let's go to the liabilities and shareholders' equity section. We already have set the short-term financial liabilities equal to 0. And now we introduce a new form of equity. We refinance the entire company. So all the existing common equity is reset to the new common equity that is now held by the management and the general partner, which is 676, and we introduce the shareholder loan. Let's keep in mind this is a payment in kind. Make this blue, and this will be in the amount of end of period 1.026. Let's make this blue. Okay, so we recapitalized the entire company. We stripped off all the existing common equity, introduced the new common equity, we introduced the new shareholder loan. We will also have paid down all the senior debt and refinanced this with the new senior debt. This was already taken from our debt schedule, so that is good. But we will want to make sure that all the cash is either used for paying down the debt or remains in the company. This company, before the LBO, was a dividend paying company. We now will reset the dividends, which will have an impact on the retained earnings. Let's mark this, and let's go back to that. Once we corrected the dividend payments, we will not pay any further dividends. We will change the dividend policy. Set dividends equal to 0. We will use all the cash to pay down the debt. Resetting the payout ratio to 0 has an impact on our retained earnings. Our retained earnings will also be reset due to the full recapitalization. And a reset means that we will retain earnings in the year 2022 in the amount of 89. And we will then again accrue retained earnings accordingly. Let's make sure that we capture everything that is equity here. We need to correct these figures. Okay, so let's check the liabilities and equity side of the balance sheet. We do have the current liabilities. We reset the short-term liabilities to 0. Let's make that blue. We have the correct sum. We introduce new senior debt, which is paid down. Okay, the total liabilities, and we have as the total liabilities and shareholders' equity the sum. Okay, very good. Now, the next step is to make adjustments on the asset side. The cash and cash equivalents need to be corrected, and they are the output of the cash flow statement. We need to come back to this, and the source for these numbers is in the cash flow statement. Let's go into the cash flow statement. We need to make one further correction to the cash flow statement. The cash flow statement was augmented with the cash that we stripped off during the transaction, but we also had a cash inflow of new debt. You have basically two options. Either you model this into the short-term liabilities that will flow into the cash flows from operations, or you model this into the cash flow from financing activities, if this is a long-term debt. We will use the first alternative. So we now need to add the payments in kind made on the shareholder loan. Since this is new debt, we put this into the increase in short-term liabilities. You could also argue that this needs to flow into the cash flows from financing activities it is your choice how to model this. The result is the same. So we add this payment in kind as an increase in short-term financial liabilities. This will have a dramatic impact on our cash flow from operation and also result in a change in the cash balance of the company. The final check always should look at the balance sheet, because once your model is up and running, it is important that the sum of all assets is equal to the sum of all liabilities and shareholders' equity. And this is the case. Our total assets on the asset side is 2.866, and 2.866 is the sum of debt and equity. So this is the augmented model where all financial statements now are linked to our LBO transaction. And now we can continue to build our LBO model to make some financial decision making. Now let's move on to the next section and hide the LBO exit value. Now we can assemble some of the pieces. We know that our entry EBITDA multiple was 8.0, and let's assume for starters that there is no multiple expansion. Let's put in an additional value of 0, which gives us an assumed exit multiple of 8x. Now, to get to an enterprise value estimate for every single year, we can now simply input the EBITDA data. Our EBITDA end of 2021 is in the income statement. We will link these numbers here. If we assume an exit multiple we can simply calculate the estimate on an enterprise value at the end of the respective year. Now the total debt is the short-term financial liabilities in the balance sheet. Year 2022, this is equal to 0. Our long-term 2022 senior debt and our cash, excluding the operational cash requirements, and we see that we will have an issue here, and we'll attend to that matter later. Now we can calculate the total liabilities, short-term plus long-term minus cash. This is the total net debt. Okay, we have a shareholder loan. There you go, shareholder loan end of 2022. And now we can calculate the value of the common equity. So we have an enterprise value minus net debt minus the shareholder loan. Now we know that management holds 10% and the general partner 90%. We can calculate the value of common equity for both of them. This is 90. And now we can calculate the theoretical cash flows to the equity investors, that is the management. That is straightforward. They hold common equity, that is it. And the general partner, which is the holding the common equity plus the shareholder loan. And we have hypothetical future cash flows, which we can use to calculate multiples and IRR. Let's move to the next step. Expand this section 8, LBO return sensitivity. In this section, we already have a matrix that directly links to the initial payment that comes from the management in G31, which was 86. We have a matrix that links to a hypothetical cash redistribution to the management on the basis of an estimated enterprise value at the end of each respective year. The same is true for the general partner. We do have initial outlay of the common equity that the general partner put in, plus the shareholder loan. This was this total amount of equity. And we link to the respective year. This is on a hypothetical basis. We use this little matrix to help us calculate the IRR and the multiple. The multiple is very straightforward. We have the sum of distributions over the sum of contributions. Same is true for the general partner. Let's check our formulas. And we can calculate an IRR using the IRR formula in Excel. That is the great thing about setting up the model as we did. Okay, and we immediately see that with the status quo of the financial figures of this company, this is a value destructing buyout. But this was the final step that we need to have this as a financial decision-making tool. Now we can talk about our value drivers and look at all the attribution that changes in the underlying business model and also changes to the financing side will apply on the profitability of this buyout. Now we can go back to the underlying business model. And the first alarming element that we identify in this company is that the operating expenses outgrow the revenues. We have an overall growth of revenues of 3% and 5% growth in operating expenses. Now the question is whether through efficiency gains this could be driven down to a steady state. A steady state in such case that we have a target of 3%, which we will want to reach. And if we know that the investment is in early 2022, we start right away. So we will decrease from 5% on a linear basis. This is simply an assumption about a linear decrease over these periods of time. We need to fix some of these items and see whether this holds. So now we have a decreasing growth of the operating expenses from 5 to 4.6 to 4.2, 3.8, 3.4, down to 3%, which would be in line with the overall sales growth. Okay. Let's further assume that we can increase the growth by 1%, also on a linear basis. Let's do this. So let's take this plus the difference between the target of 4% divided by the count. This to this. Okay. This is decreasing granularly. Okay. So we already see that this is increasing our net income. The question is also, is this already enough to keep our cash balance on operational levels? And this is not the case. We need to have a minimum cash equivalence of 50. This is a target. So we need to dive deeper into the cash conversion cycle. The cash conversion cycle now is comprised of a day sales outstanding of 60. If we were able to decrease the days sales outstanding by 5 days, we would end with 50, with a target of 55. Now, let's assume that we gradually move down. Let's make this formula usable in such way that we only fix the column R, the column M, the column Q, in such a way we can use this formula with a copy and paste to make adjustments in a way. Okay, days sales outstanding, a decrease down from 60 to 55 will not be enough. If we also can change the days of sales in inventory with 180 to 160 target, can use the formula now, and we see how slowly but gradually our cash balance gets better and better. Now finally we have the day sales outstanding, the days sales in the inventory. If we could increase the average payment period by 10 days with a target of 40 days of payment period, can use the formula, copy paste, and have an increase of 30 to 40. Okay. Now finally we need to take a look at the cash balance, and this is still not a sustainable cash balance, which is mainly due to the fact that we pay out too much. We are left with 9 million in the end of 22 and minus 21 million in 2023. And this is due to the assumption that we pay out 200 in debt pay down. So we know that 200 is too much. Minus 200 plus 50 minus 9. A 159 of debt payment in the first period should equal to an ending cash balance of 50. So we see in the end of cash balance, now we have our cash on the target of 50, and we can increase the pay down, all else equal. So we could here subtract 9 and another 11, another 13, and another 17. This would keep our cash balance with an ending cash balance of 50 in line. This is a stable and sustainable business model now. Let's check in our balance sheet. We have 50 in cash. We now know how much this business, all else equal, could afford to pay down in debt. So let's take a look at the profitability. This looks much better. If we assumed an exit in the end of 2025, the management would make a cash multiple of 1.85 and an IRR of 13%, while the general partner would have a multiple of 1.7 and an IRR of 11.3%. Now, we have further enhancements and efficiency gains to work on the fundamentals of the company. We did look at an increase in the sales growth to 4%. We did look at a decrease in the operating expenses. We could also have a look at the cost of sales. This is a very typical way if we can renegotiate all the supply contracts. Let's assume that we can increase our margin by 10%. This would give us a target of 60%. So let's take 70 plus 60 minus 70 divided by the number of steps. That is fixed. And we have a slightly decreasing by increasing the efficiency and the cost structure. Now let's take a look on the profitability. And now we have a highly profitable LBO. If we sell in 2024, the management will make a cash multiple of 5.2 and an IRR of 51%, while the general partner makes a multiple of almost 3 and an IRR of 30.9%. Now you have a decision-making tool where you can test various scenarios and see the impact that your changes have on the profitability of this buyout. I hope you enjoyed the video. Thank you very much.